This week on the Altimetry Authority, we've got 4 interesting topics for you. First up, we've got US versus China versus Russia. Everybody thinks that it's a leveled geopolitical battle. The reality is there's a reason why we think the US is going to keep on coming out on top.
Then we're going to talk about the AI hyperscalers and, in fact, just US CapEx in general, where it's being spent. You know it's being spent on energy, and one of the benefactors is Constellation Energy. We think Wall Street is completely missing the boat on this one, and you need to hear what we have to say to understand what to do with Constellation Energy.
Then we got Wall Street's wrong again. Dollar General, the trade down effect, inflation, and also tariffs. Why Dollar General might actually be totally misunderstood by Wall Street and have a bunch more upside.
We know the world is spending more on defense. We know that Rheinmetall, the biggest German defense company, is going to benefit from it. But how much should they benefit? How much will they benefit? And has the stock maybe run its course because of it? We'll find out now.
This week on the Altimetry Authority. Let's talk earnings and
favorite pastime.
So let me just say,
Wall Street
It's 2.5x.
because their compensation goes up.
Wall Street's wrong again. So, Joel, everybody's talking right now in terms of, this perspective, hey, the U.S. is negotiating with Russia, the U.S. is negotiating with China, how's it all going to play out? We're trying to figure out what's going on from a tariff perspective. We're trying to figure out what's going on from a geopolitical perspective. I think we have a different take in terms of understanding what's really going on and where the sources of power are going to be, so where this will all settle up. You want to take everybody through it?
Sure. I mean, when you think of global economic power, right, it is still driven by who has the money, whether we're talking about military or whatever. And so if we look at tax revenue, and I say tax revenue, we're actually talking about full federal revenue, whether it's tax or excise tax or fees or tariffs or whatever, right, around the world. And so in 2020, if we take the world as 100% of all tax revenue, and I'd say federal revenue for governments, not including states or provinces or anything like that, the United States was collecting, back in 2020, 25% of all the world's taxes the U.S. is getting. So when people say, why does the U.S. have the ability to fund the biggest military in the world or to fund large debt levels or whatever, it's because it actually is generating more tax revenue, more federal revenue than any other country. And the next closest one is actually China, and they're about 15%. What's crazy is that China is doing 15% by not following the Laffer curve, meaning they believe, it seems, that by continuing to raise tax rates in all kinds of ways, tax rates, tax levies, sales taxes, VAT taxes, you name it, that's how they're getting the 15%. So the United States, on a much lower tax rate schedule, right? Real effective tax rates, is generating a lot more money. That means it's a lot more sustainable. And that's the big two, right? After that, you've got the rest of the countries. Japan is next, Germany, France, right? United Kingdom, and all other. What's interesting is you notice in terms of tax revenue, even back in 2020, Russia's not even on the top of the page, right? Russia's tax collection is low. So if we roll to 2022, and I think that's an important point for understanding war economics, right? In 2022, the U.S. had already grown to be about a third of collecting the world's taxes. What's happening is China, because the tax rate is so high, it is killing entrepreneurship. And it's reducing people's interest. It's reducing people's interest in working harder, because at some point in China, you're collecting maybe 70% is being taxed, and you're only collecting 30% of the marginal income that you'd make. Well, when that happens, it's been proven in the U.S. and anywhere else that people just stop working as hard, and that's the issue. So they may have a lot of people, but those people aren't working as hard because they don't get the incentive for it, because the tax rates are really that high. Effective income tax rate in China is probably around 70-75% if you make more than $140,000 a year.
Well, again, right, and there's this whole entire narrative that on purchasing power parity, China and U.S. around the same GDP, blah, 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 blah. But it's like, no, actually, when push comes to shove in terms of the budget of the government to be able to spend money on stuff, congratulations on purchasing power parity. The reality is, for the stuff that you want to access, they've got a lot less money to be able to spend on it. And to your point, Joel, what really comes to the idea is Russia it's a paper bear. Like it's not even on the radar in terms of what's going on.
It's not even on the radar. And so these are the actual slides from a couple of years ago, right? This is from 2 years ago that I was showing inside the Pentagon and elsewhere, some of our biggest investor clients who just want to understand global macro. When you think of this, that the U.S. by 2022 was already a third of the world's total revenue would collect in the U.S. alone. That means more than the next many countries combined, right? When you look at it, including China, you start saying well, that is a source of economic power. This is why when Russia invaded Ukraine, one of the things that we talked about was that Russia's total federal revenue back then was maybe $350 billion. And the U.S. was well over $4 trillion. $4 trillion. So for the U.S. to say, all right, we're going to, give Ukraine $100 billion. All right. Yes, it increases the deficit. Yes, it's a little bit of an issue. But when Russia says we're going to have to spend $150 to $200 billion by themselves because they're not getting support from anyone else on this war, there's nothing left. There really is nothing left for the rest of the country, for the infrastructure, for the roads, for Social Security, for you name it. Now, I'm not saying nothing, but so little for a country that is one of the biggest land masses in the world, one of the biggest borders in the world with other countries, and with 130 million people. They don't have 120 million, depending. They just don't have that much money. And so for federal revenue. And part of the reason in Russia is also very high tax rates. Now, to bring it alive, I'm just going to say that what we were forecasting 2 or 3 years ago, and I'm going to bring this in, but by 2035, we said you'd have the U.S. with a collection of tax revenue that exceeded all the rest of the world combined, right? The only change to this slide from 2 years ago when I first showed it is that given everything we've seen around the world and in the U.S. and in the economy, is we're looking at a U.S. economy where this is going to happen probably by 2030, if not sooner. Meaning within the next 5 years, you're looking at a situation where, because U.S. tax revenue keeps rising on lower tax rates, where other countries of the world, like China and Japan, and frankly Russia, on much higher tax rates, are stunting the growth of their economies, because that's what happens. When you tax production, people don't produce as much. When you tax gasoline, people don't drive as much. When you tax cigarettes, people don't smoke as much. When you tax incomes, corporate and individual incomes, at high enough levels like China certainly is, and also Russia I'd throw in there, but not as bad as China. China's very, very bad. You will stunt growth. You will shut down incentives for people to work, because why would you work so hard? Why would you work so hard if you're only going to keep 30%, 25% of what you make? You just don't work that hard anymore.
You either end up, right, they stop working, or they start working under the table, in which case, basically everybody says, oh yeah, we're just
Even
not
worse.
paying income taxes, and then the government doesn't have any revenue, right? Yeah.
Even worse. And that's the issue, that in China, because the taxes are so high, Rob, good point, China easily has the biggest black market of goods on the planet. The biggest black market of goods and services on the planet, even to the point where people are bartering. Because if the dollars show up somewhere, they don't want to pay income tax on it. And so they'd rather, right, trade or just do stuff in cash, which of course is illegal, but there's not much you can do when you start taxing at those levels.
Joel, do you think it's, for us to say 51%, right, that is a big jump. Is that purely us growing, or to your point, is it them shrinking? Is there a demographic dividend issue that you think it is, or is it purely just tax policy? What do you think is the way that we're going to see that much of a ramp? Is there some other calculus that we've added that we're not thinking of?
It's a couple things. So one, the Laffer curve, right? Art Laffer should win the Nobel Prize for this, but he won't. All right, he won't because of the political nature of it. But Laffer was saying when you start with high tax rates and you reduce them, you actually increase tax revenue. When you increase tax rates that are already high, you reduce tax revenue because of things like the black market, and frankly, people just stop working as much. We saw that in the 1930s in the United States, where the U.S. had tax rates that are about as high as China has now. We saw the 1970s in the United States, where the U.S. put in marginal tax rates that were about as high as China is right now. And now China's experience, because somewhere they didn't get the message, they didn't get the research, that when you put in tax rates like that, you end up with the 1930s Great Depression, and you with the 1970s. right? And that was, both of those were income tax driven recessions and depressions, both the 30s and the 70s. It wasn't because of tariffs. Tariffs played an issue, don't get me wrong. But no, most of the reduction in GDP in the 1930s of 40% was because FDR raised the tax rates to like 70+%. Well, that's what you're seeing in China right now. Right now,
So,
you're seeing those kinds of taxes.
So let's put that in context,
On
Joel,
incomes.
because I think you have some good data in terms of, talking about the difference in effective tax rates that we can look at across the world.
So Steve Ballmer, since he left Microsoft, has been trying to do, I guess, some good. And he does this thing on
he's
YouTube
not
called
just-
USA Facts.
He's not just spending his time owning the Clippers and building a new stadium. He actually is trying to
That's
do good
right.
for the world also.
Although he does specifically mention that when he talks about who he is at the beginning of the of these videos, but he does these videos called USA Facts, and they're just good general what's going on with taxation, what's going on with corporate taxes, what's going on with certain government programs or whatever, and very apolitical. He just says, here it is, here's the data, and you decide. But just to make a point, when I say that China has very high tax rates, in the U.S., if you make $54,000, and that is the primary, that is the median income in the U.S. right now, $54,000 adjusted gross income taxpayer will be in a 12% tax bracket. But that 12% tax bracket, that's the marginal rate of tax. Their actual effective tax rate is only about 5%. Really. It really is only about 5%. That is a fairly low income tax. It's also very regressive. That gets very high. It's very progressive. It gets very high when you go up to higher brackets. But at $54,000 a year, to say you only pay 5% federal tax, you will also still pay FICA, right? You'll pay Medicare, but that totals 7.65%. And if you include even the employer side of that, then it's like 15%, 15.3, right? So you're still saying you're at a fairly low, you're definitely a low federal income tax rate. And then when you add in Social Security, all right, gets you to around 20%, maybe even when you include the federal side of it, right? Now, let me show you China just to give you an idea. This is in renminbi, right? This is renminbi, and I got to thank the website that built this, because I did not build this slide. They did such a great job. And what they said is we have to focus on the tax wedge. The tax wedge isn't just how much a person is taxed, because the employer side of taxes are saying, what's the cost of someone's labor? And then what is the net salary the person gets? Because ostensibly, if you didn't have such high employment taxes, the company could pay you more. Right? If a company, if we didn't have to pay our people the additional in the U.S. 7.65% of the employees wage plus the 7.65, well, that money would be there for employee money. It's not like we just take it and say, let's make a profit. To be competitive, we have to. Right.
That's why we and everybody else, right, figure out ways to pay non-taxed benefits, right, for that reason.
Right.
Yeah.
So now that is the employer side is 7.65%. What I don't think people realize that for someone in China who's making only $1,000, let's say $1,200 a month, 10,000 RMB, right? 10,000 RMB divided by about 8 or 7.5, depending on the day, right? But divide by that, and you're at like $1,200 a month. At only $1,200 a month, just $1,200, right? Their paycheck, that person's paycheck, would first have a 40% hit of employer side taxes. So their 10,000 paycheck would be after the employer had to already pay 4,000 renminbi. Right? 40% of that amount. That is a tax wedge, right? In the U.S., that's low. That's only 7.65. There it's 40. And then when you look at what they say is, again, employee side taxes of social insurance and housing fund and whatever, you're looking at, and then on top of that, their actual individual income tax, IIT, you're saying that someone who costs a company 14,000 renminbi only ends up receiving just under 8,000 renminbi. It's almost 50%. And that's for low income earners. When you get this to someone making more than $140,000 a year, which people in the major in Shanghai and whatever are making those kinds of dollars.
Oh, yeah.
When you start hitting 140 grand a year, the effective tax rate above that amount starts hitting not 50%, like you see here, but closer to the full tax wedge, as they call it, is closer to 70 to 80%. Now, what we're talking, so 70 to 80% effectively, when you add everything in, and the fact that, of course, in China, like in the U.S. or anywhere else, they tax inflated income. If your income goes up because of inflation, you literally pay more tax, right? Unlike, well, if you did it correctly, you'd say we only tax real gains, right, and real income levels. But no, in most of the world, governments tax inflated levels, and that does result in the government taking more share effectively of your income or of your gains, right? Because some of your gains are just from inflation. Why should you be in a higher tax bracket because of inflation? That doesn't mean you really made more money. Well, that's the issue. So when you look at this in China, we understand why China is having more and more trouble raising any more taxes, because they're already at the far end of the Laffer curve. The far, far end of the Laffer curve. Russia, not as bad, but similar. I get trolled sometimes because they'll say Russians have to pay such high taxes, and if you're a foreigner living in Russia, it's even double that, right? And people are like, oh, no, I just Googled Russian taxes, and it's only like 13 to 20%. Like, yes, but did you include the social payments of Russia? Then the social payments in Russia, not as bad as China, but similar. And employer paid. So you have to think about the tax wedge. Right, because there's a lot of countries like that where they're like, well, no, but the employer's paying it. You're like, yeah, but that's still part of the total labor cost, right? Some of that money, and in many cases, all of that money to keep up with the market would go to labor, would go to the employee. But saying it's employer side or saying it's employee side is kind of nonsense, right? At the end of the day,
just because you don't see it, Exactly. Just because you don't see it on your paycheck doesn't mean that when the company is doing math, they're not calculating that in as part of it. And so you think of that you got to think it all together. Exactly.
Yes. And if the company didn't have that employee, they wouldn't pay those taxes, those employer-side payroll taxes. So Russia is not as bad as what you see here with China, but it is pretty bad. I mean, the fact is you can't tax revenue, right? This is an important point. You can only tax profits, and that's for companies. And so if you want economic growth, right, you can only tax economic profit, and this is one of the points we're making. The U.S. companies produce more economic profit than the entire rest of the world combined already. So even though it's a lower tax rate than many parts of the world, corporate, right, is now lower because of Trump from 2018, right? But also income taxes in the U.S. are lower than places like China and Russia and in many parts of the world. Bracket for bracket, they are lower. So when you add that together, you start saying, oh, so if the U.S. is generating more economic profit and Americans have more disposable income and they keep growing because of this, because you can grow an economy and whatever else, then there's every reason to say, why shouldn't the U.S. be collecting a lot more in tax revenue as the economy grows on lower tax rates, which is, while the other countries have already maxed out. They're just... China can raise their tax rates more. They're not going to collect more in taxes because they'll just shrink their economy by so much there won't be a profit to tax on.
I mean, I think the big takeaway, right, Joel, is, I mean, when you think about this, there's constantly narratives out there about our near peer in terms of China, the shadow of the spookiness of the USSR that we all have, that always is looming over us, and how we all give so much reverence to Russia as a geopolitical player. But the reality is we have such in the U.S., and this is the important thing to come back whenever you get worried about, should I be investing in the U.S. versus should I be investing in the rest of the world? Is China going to catch up to the U.S. or anything like that? You got to keep on coming back to this idea of we have such an embedded advantage, right, in terms of the money that our government can spend and we can invest, and then also how much our companies and individuals do too, that it's really, I think the point you're saying, Joel, is it's really not a competition. There's a giant and then there's a whole bunch of midgets behind them.
Yeah, it's these pictures they use of GDP. Well, you can't tax GDP, I'm sorry, right? But the pictures they use of GDP, and they say, well, there's the US and there's China and then there's Asia and there's whatever else. The real picture you should be thinking about is what is the tax base and the ability from an economic power standpoint. And you would have, the United States would be, 70+% of the picture, and every other country in the world would be just hanging off it. And the more countries don't want to hang off that, meaning North Korea, Cuba, Venezuela, you can go around the world, right? You notice that those countries just can't survive without benefiting from the U.S.'s economic profits and the U.S.'s disposable income amongst individuals. Partly because the U.S. does not, believe it or not, all right, I know people complain about taxes, it doesn't even come close to what the tax burden is in China. And when you look at that and that sustainability, it says then the U.S. economy can still grow, and on a lower tax rate, U.S. taxes still grow. Right now, this year, we're best guess, again, it's best guess, we're not even halfway through the year, that the U.S. is going to generate $5.5 trillion of federal tax revenue this year. $5.5 trillion. While Russia, maybe $300 billion. Maybe. And that's on much, much higher tax rates. And and collecting pretty much all of their oil and gas revenue on top of that, meaning there really isn't much left going on in Russia other than them trying to fund that war in the Ukraine, and it's going to be a big. It really is spelling the end of the Russian Federation over the next 10 years, unless they put a stop to it like immediately, because they just don't have the money for it, right?
Yeah, and anybody who thinks that Putin is the one in the upper hand in all these conversations is probably losing it. But the point, everybody, in case you haven't noticed, if you've been paying attention to the Altimetry Authority for the last couple episodes, and you've listened to Joel and I for a while, it's our point is, look, if you buy America and you bet on the U.S. winning, as Buffett always said, you're probably going to get right. And so, with betting on America, let's talk about one of the biggest reasons that we can bet on America right now, which is, of course, the world of data centers. And we're going to talk about data centers in the sense of power right now. So there was a big news story that came out just last week around the idea that Meta followed on the footsteps of Microsoft and went to Constellation Energy and said, hey, Constellation, in 2027, you have a nuclear plant that is coming off of effective contract with Illinois. We want to buy all your power from it. And it's really useful to remember this. And right, everybody, for context, right, Constellation Energy is also who owns 3 Mile Island, who Microsoft just agreed to do this about last year. And so, there's this huge narrative, everybody, that came out earlier, like literally 2 months ago. Oh, data center spend is over, the AI boom is over and everything else. And headlines like this kind of put it in perspective. But we wanted to come back to a chart that we had showed last time that we talked about data center spending to remind you just why it is that Meta and Microsoft and everybody else can do what they're doing right now and aren't going to stop. And why we need to not forget. Yeah, the hyperscalers, just like don't forget betting on the US is going to win, don't forget betting on AI is going to win. And the reason why is if we look at the hyperscalers here, so this is, right, uniform accounting earnings. When we clean up the earnings, see through all the accounting noise, and Joel, there's a ton of accounting noise that happens for these companies because of everything from R&D to stock option expense to everything else, right?
Gap accounting punishes innovators, meaning more than it should. It makes companies that are growing and innovating look a lot worse than they really are. That is gap accounting. Accountants are very conservative, and in certain areas, the more conservative they get is where they're like, well, if we don't understand what's going on, we're just going to treat everything as an expense as opposed to an investment. Right, and we're going to expense it even earlier than the actual charge should be matched against, right, in terms of time used. And so it makes companies that are growing fast and innovating a lot and spending in R&D look a lot worse than they really are. That's U.S. GAAP. IFRS is not as bad, believe it or not. International accounting standards. U.S. is much more punishing. U.S.
Yeah,
GAAP.
2 point, because the things like R&D where where they can capitalize versus everything else. But for everybody, for context, right, the biggest companies in the world, the hyperscalers, right, we picked off Microsoft, Alphabet, Amazon, Meta, and then we also included Oracle, which is really, everybody would argue, kind of the number 5 there. Their real profits understate just how much cash flow they're generating to invest. So what we did is we looked at it on a uniform accounting basis. These companies last year threw off $380 billion of profits. In 2025, they're forecast to generate $400 billion of profits. And that means they have a boatload of money to spend to invest in CapEx for growth, to invest in investing in growth, right? This here, what we're showing you in terms of hyperscaler investment, this is growth investment. This isn't keeping the wheels on investment, which we're actually putting aside. We already include that, analyze that in their earnings number. This is growth investment. They spent $330 billion last year. They're going to spend $310 billion in growth investment this year. On top of the $330 billion last year, they're spending on AI, on the AI boom, and they're going to keep on spending on those data centers. And that's important. Yeah, go ahead, Joel.
And Rob, not just those companies. I mean, the United States generates more economic profit than the rest of the world's companies combined. What that means is, if you need money for R&D, it has to come from your economic profit. It can't come from the plain accounting profit, because that money is needed for dividends, for a certain amount of cost of capital. It's money that's needed for just keeping the lights on, right? What Rob was talking about is it's not keeping the lights on, meaning if you have a factory, you have to maintain it, right? That's not growth capital. We're saying, where do companies have the most growth CapEx available? And it's the hyperscalers specifically, but honestly, it's the whole United States. The U.S. corporate all right, economic profit level, allows for a level of innovation that you don't see anywhere else. And where are they spending? Not just hyperscalers, but the whole U.S., right? They're spending on AI in a big way because they know it's going to work.
And AI means we need power, and that comes to Constellation Energy. So for those of you who don't know Constellation Energy, this company is if you think nuclear in terms of nuclear that is actually on the ground installed right now, it's Constellation Energy, right? They are 90% nuclear in terms of how much energy they produce, how much power they produce. Now, of course, it's like 65 to 70% of their optimal amount of power production. But the reason why it's 90% of the total power produced is because nuclear energy tends to not be offline. Unlike you have to maintain gas plants, you have to maintain, if you have coal, you have to maintain all these other things. So because of that, nuclear is a phenomenal baseload power source for something like AI that needs to be running constantly. And so when we look at Constellation, they're getting all these contracts from the hyperscalers because of the fact they know that this is nuclear baseload power they can trust, which is why, right, everybody is running around trying to figure out nuclear. But there's something really interesting that's happened with Constellation because of what we're seeing in terms of all of these hyperscalers' interest in being able to spend on nuclear. And for perspective, Joel's going to take you through right now what the uniform accounting is showing you, but I want you to think about this in terms of regulatory power means you have a set price you can charge for power, but selling power to individual companies, there is not that same price. And we'll talk about the prices in a moment. So Joel, let's take everybody through really quickly what it is that the uniform accounting is showing us about this transformation.
So when Rob mentions that regulatory power, meaning where your price fixed, where the government controls your pricing, that is what it looks like. Meaning when you can't control your price, when you cannot price on a free market, what do you end up with? And on a uniform basis, they end up with a return on assets in 2020, 21, 22 of a less than 5% return on assets. U.S. corporate average is 12 to 14. Global corporate average is 6. China, Germany corporate average is around 4 to 5, and this company is generating even less than that. And what does it mean? It's because they're not allowed to compete. They look more like a Chinese or a German company, meaning where there's more about stakeholders and they can't really seek profits and they can't be free market. And so you end up with return on assets that's much like, frankly, those countries when you're overly regulated and the government is telling you what to do. What's interesting is by 23, it starts popping up. By 24, it's grown to at least being back to kind of global corporate averages of 6%. But that's a big difference from 2021, 22. And then when the Wall Street analysts look at this, and we take analyst forecasts that there's at least 15 or 20 that are actually doing decent pro forma financial forecasts, not that ridiculous single line EPS estimate, and not that buy sell opinion, which is, well, it's always buy or hold, which is just nonsense, right? It's their actual detailed forecasts. We put those together, and you end up with Wall Street saying, no, returns are actually going to keep going up towards maybe towards U.S. corporate averages, I don't know. But at least the analysts are saying it's still going to continue at this really higher plateau level, which doesn't reflect a company that's bound by regulatory pricing. It says there's something better coming in.
And then, right, Joel, when we look at what the market's pricing in, this is what's wild, right? Everybody might look at this company and say, hold on, this company has had 4% return on assets year in, year out. And now the market, so these white bars are what at a current $91 billion market cap for Constellation at a 300 give or take dollar stock price for Constellation, what investors are paying for in terms of earnings. So investors are paying for this company's earnings to get to 11%. Now you would look at the history for this, and if you didn't know anything, you'd say this is crazy. This makes no sense at all. This company should be a glaring and obvious short. But here's the interesting thing that comes into play. So when you talk about how much Constellation Energy was selling that power for, the nuclear generated power in Illinois, when they had basically a regulatory deal that was helping them basically fund clean energy, which is what nuclear energy is, they were getting about $45 per unit of power, right, is a way to think about it. And give or take, right? The numbers aren't exactly right, but roughly. The word on the street is the amount of money that Meta is going to pay them is $90. Doubling the amount that they were getting in terms of when they were a regulated utility. And by the way, when we talk about what's happening with 3 Mile Island, Microsoft agreed to something like $100 per unit of power. And so this is really important because utilities, as we all know, are huge asset-intensive businesses. So you double the revenue that you're generating, you don't just double your profits, because you've already covered your fixed costs. There's no marginal cost to running a nuclear power. There is, but not really. In terms of a nuclear power plant, all the rest of that drops down to profit. And so you want to understand how this company could have return on assets that's at 11%. That's how. For context, it starts to look more and more like what's called an independent power provider. An IPP is what people call it in the industry. So there's regulated utilities, which have to go to their regulator every year and ask for be able to higher price because they're going to invest more in their business, or IPPs that sell power wherever power is wanted at market prices. And so one of the biggest IPPs, Vistra, generates an 11% return on assets each year. So we really thought it was great to highlight with Constellation Energy that, one, when you think about what's happening in the hyperscalers, they're not stopping their spend. And if they're not stopping their spend, you are going to see huge demand for power, and you're going to see more and more things happen like are happening for Constellation. So don't think that Constellation Energy is expensive because these expectations are so high. Recognize that the reality is Constellation Energy actually, it makes perfect sense for it to do it. So everybody, the point is, look, Constellation, it looks like it has a crazy high valuation. If you look at PEs or anything else, you're like, what is going on? It makes sense why it's here because there are big changes happening that really can re-level its profitability, and Wall Street is totally missing it. All right, Joel.
Yes.
Let's talk about another company that Wall Street is totally misunderstanding, and that is Dollar General. Everybody,
Yes,
Dollar General last week came out, basically posted strong results and came out with really, really strong guidance, sent the stock popping more than 10%. Basically what happened was they said, hey, look, we are not seeing the issues that we thought we were going to see in terms of, inflation is starting to moderate. And also on top of that, we are seeing a trade down effect from higher end customers trading down from the targets of the world to come to us. And so because of that, we're really actually seeing things that are going better. And what was really interesting was on this news, Oppenheimer upgraded Dollar General to basically to outperform from just perform, whatever perform means,
whatever
by
that
the way,
means.
which is
What a bunch of nonsense, Oppenheimer. Perform
But
to
here's the best
outperform.
part.
Meaningless statement. Totally meaningless statement on the part of the analyst. What does that even mean? Like they forgot English? Oh, it's going from perform to outperform. Well, put some numbers behind that. Anyway.
Right, but if you look, and so when Oppenheimer said that, they raised their price target for Dollar General to $130, right? Current price is $110 a share. Now, first off, $130 isn't even higher than the 52-week high for Dollar General. More importantly, any Wall Street investor worth their salt will tell you if a company is undervalued or overvalued by 20% on your model, whatever your model is, that company is fairly valued, right? Because effectively that 20% is a margin of error because who knows what you're getting right or wrong in terms of your model because all Excel math is magic anyways. And so because of that, so they're not actually giving you, when they give you the price target, that this is an upside company. But you look at it and it's just so laughable because this is a company that has gone through a huge story that's going on here that the market just isn't picking up. And so Joel, in that context, let's take everybody through just how big of a deal it is that Dollar General has a pulse and why that could mean the market could have a lot more reason to have optimism on it going forward.
Well, the stock gapped down last September because of inflation. In fact, that inflation concern, meaning Dollar General can't, as Rob, what's your joke? It's Dollar General, not $1.50 General.
Yeah,
so if
yeah,
you
dollar,
have,
not $1.50. Yeah,
it's not a $1.50 General. It's a Dollar General. It's actually difficult for them to pass on cost to customers. And even if they do, so if they're selling eggs and the price of eggs go up by 50%, they're going to sell less volume. Right? It's not like they're going to maintain volumes if they have to, or they're going to have to eat some of the costs because they have to maintain that. We're the lowest price, right? It's Dollar General is mainly rural. This isn't the dollar store that you see when you drive through cities and urban areas. This is the Dollar General that's in the middle of nowhere, right? Little small towns or whatever. Now, when you see the impact of inflation, the as-reported ROA showed it's falling. So it said, hey, this is a 9% return business, and it's been falling into 2025 from 9, getting cut in half essentially. That's under GAAP accounting. When you look at the uniform numbers, you find it actually was a much better company, and the drop is a lot worse. Like the GAAP accounting did not reflect just how strong and how problematic the increase in inflation has been and on their costs, right? So the inflation has come in, particularly U.S. inflation, the costs are there, and then ROAs collapse. So what we're seeing, though, as everyone knows, is there's going to be lack of inflation, right? Less inflation anyway. 2 to 3% is what we're looking at right now. And Wall Street analysts are saying, yeah, all right, whatever Dollar General's done before. Now, this is this is not based on EPS. This is based on their pro forma next 6 to 7 quarter financials, which we think are pretty good when Wall Street does that level, because they're usually not done by the senior analysts, just being honest. They're done by the research associates, the junior people who actually have some, credibility. Anyway, at least before they get promoted, and then they lack it completely. But anyway, when they do this, Wall Street's saying, all right, and there's a good 15, 20 analysts covering Dollar General. So this is a good consensus saying, all right, returns have fallen, but they're going to flatten out. Now, I think Wall Street's missing it completely, because the returns have only gotten this low because they had such high inflation, right? Now, what people are also saying is, well, what about what happens in Walmart and what's happened at Target, meaning tariffs? Well, this is the interesting thing. Most of Dollar General's goods do not come from China. I mean, where you'd argue Walmart and Target are somewhere between 25 and 50% indirect, right? Not just direct from China, but from other countries that might be getting some of their stuff, or just rebranding from China, which happens a lot, right? Happens a lot. Walmart and Target are succumbing to that. Not to mention Dollar Tree, which probably is 40+%, right? At a minimum. When you look at Dollar General, their imports from China are maybe 4% and probably less, and actually total imports are more like 10%. So
right, because the difference,
they don't have the tariff problem that all the other retailers have. They really don't.
Yeah, because to your point, right? I mean, Dollar Tree, it's a lot of tchotchkes, right? It's like stuff that it's like cool for people to grab and everything. Well, Dollar General, it's a lot more. Here's food. Here's consumables like paper towels that actually, surprisingly enough, everybody, in case you didn't know, actually get made in America or made in Canada. But so it's like those things, and so because of that, they're not as sensitive to it. And so there's this kind of, to your point, Joel. It feels like, they're being painted with the same brush on a couple things. One, inflation. 2, tariffs, and 3, consumer pressure. Is this narrative that everybody is painting around them, including their analysts, and also, right, that the market is painting on them too, in terms of what the market's pricing in, right, Joel, in terms of, these white bars.
So notwithstanding Rob's mispronunciation of Yiddish terms, in my humble opinion, like tchotchkes,
I'm shocked.
I would say
shocked I mispronounced that.
I would say that Dollar General, does sell a lot more basic staples, and if there is any kind of recession, or just in general, they should get a trade down effect. But unlike Walmart and Target and Dollar Tree and a lot of other firms, they're not dependent on tariffs and imports. So a low inflation environment and a non-tariff dependent company should have a lot more positive news coming out on balance than negative news. And yet the worst negative has been priced in. It's saying that things aren't going to get any better. And actually, you'd argue that pricing in at these levels, you're saying inflation will continue to be high, as opposed to, as it's come down, Dollar General should benefit, meaning returns should start popping back to 2022, 21 levels. And if that's the case, this stock has tremendous upside. Incredible upside on the stock if they can get back to those 22 levels, because the market and the analysts seem to be writing it off. And honestly, they're probably writing it off thinking, yeah, the tariffs are an issue and whatever else, and not realizing how Dollar General really is like more of a consumer staples, not a electronics or whatever kind of tchotchkes, as Rob had said.
Exactly, as I so eloquently said. Anybody who knows me, you all would, if you knew me, everybody, you would know it's not surprising that I brutally mispronounce something. This is a normal occurrence that Joel would confirm. But I think, Joel, the other thing about this is, and this is the other big thing for these guys, and that's happened, is if you think, right, and everybody, when you look at this is a company. It's a little bit funky in terms of its fiscal years. So it ends its fiscal year every year in January. So 2023 fiscal year is actually 2022. 2024 is actually 23. 25 is actually the 24 calendar year mostly. And so you look at that, and what happened, right, to Joel's point, is mostly inflation was what killed it. Now, the other thing that's been looming in terms of right now that we've only kind of touched on briefly is that idea of, look, the low-end consumer is under pressure, right? All the data shows it. We talked about 2 shows ago the idea of the student loan apocalypse and how all the things that we're seeing for pressure with consumer credit and what that's doing for low-end consumers. So that's also been the other overhang, everybody, that people have been spooked about Dollar General. But here's the thing, and this is the big thing that happened on that earnings call, is Dollar General is structurally seeing a trade-down effect, where people who used to be shopping at Target are going to Dollar General now. And what that means is that idea that there's the low-end consumer might buy a little less from them because they have a tighter wallet. There's no trade down that they can have beyond Dollar General, but the low end of the middle coming down from Target to them actually gives them a floor in terms of demand in the short term. And all the other stuff that you, Joel, talked about, it says there's nothing structural that's changed about Dollar General that means its return should be this low, everybody. And that's why, Joel, to your point, we think that Dollar General could be a very, very interesting place to weather out the storm. We're looking at it. We aren't recommending it yet, but we're definitely looking at it.
Yeah, I mean, to get to our recommended list, we really have to have the highest level of conviction. We're just letting people know that this is one that is in our pipeline now, and we're looking at because it's very, very, very interesting. So,
yeah, exactly. And everybody, we started the show talking about, call it geopolitical concerns and how Russia may or may not be a paper bear. Let's talk about one of the companies that's actually been benefiting from everybody's concern about Russia and everybody's concern in Europe about whether or not the U.S. is still going to give them the safety umbrella the U.S. used to give for them to be able to, not spend as much as defense as they maybe should. And so for everybody, right, earlier, I want to say it was in middle of May, there was a big story that came out, right? It wasn't just that NATO was flirting with the idea of 5% of GDP spent on defense across the entire alliance. They were going to really commit to it. And that was a big deal. And the reason why that's a big deal is if you look, the vast majority of NATO spends nowhere close to that. Honestly, even the U.S. doesn't spend 5% of GDP on defense. We spend like 3 to 3.5, I think is the number that we spend. But you look here, the vast majority of European countries barely were getting to NATO's old target, which was 2% of GDP spent on defense before they upped this spend. And so you just do the simple math. And 2% going to 5% is going to be a big deal for defense contractors if a lot of these countries have to spend a whole lot more. And that got everybody focusing on Rheinmetall. And because of that, Rheinmetall, which for everybody, for context in terms of what Rheinmetall does, Rheinmetall is Germans call it national championship for as a defense contractor. Their big
guns
businesses are, guns and ammo. Exactly.
Ammo.
They make tanks, like the Puma, the Leopard, the Leopard, and everything else. And then they make ammunition. They make, the artillery shells that go in that we're using in Ukraine and everywhere else that are, basically, that's what they do. But because of this, in terms of the expectation, literally in the last year and change, Rheinmetall is up 500%. That is NVIDIA-type returns. Yeah, go ahead, Joel.
Yeah, when you hear Germany and Europe saying we're supporting the Ukraine, Rheinmetall is the one getting a lot of that money for providing guns and ammo and whatever and tanks or whatever to Ukraine. And that's obviously why they've done so well.
Right, exactly. And I mean, artillery shells being the biggest thing that are just, flying off the shelves. But literally 540% upside. Like NVIDIA would be very happy with that kind of return. And this is a 100+ year old German defense contractor. So let's talk, Joel, a bit about what the uniform accounting and as-reported accounting shows as to whether or not that mania of 540% makes sense to have optimism for.
So the GAAP accounting numbers going back to 2020 and over the last 5 years, you would expect the company's returns to improve, and they have been, but on a uniform accounting basis, because German accounting is under IFRS and IFRS is not accurate, you would actually see that, no, there's been a big pop in profitability. Now, the average German company is about a 4 to 5% return on assets. So the fact that this company was down closer to the average, but not quite, and then is jumping up to 10, 11%, is telling you that this company actually is producing a profit at levels that exceed what you see from most German companies, which means they are benefiting from all the unpleasantness going on across the world, and particularly in Europe. Now, you had in Wall Street analyst forecasts, and there are analysts covering this stock. Now, this, by the way, people have asked, this is a German company. Why is it in the altimeter? Because the altimeter is mainly U.S. stocks. Yep. It is an ADR, an American Depository Receipt, which means it does have the license and legality to trade on U.S. exchanges. And because of that, we get plenty of data, all the data we need necessary, because we might not always get as good data if they're only filing in their local country. But because they're filing both in Germany and then in the U.S., we can get all the data necessary to convert to uniform accounting. And that's why it's in our database. So when you look at that and you take the analyst estimates that are covering it, Again, the pro forma financial estimates of the next 6 quarters. We don't care about their target price because they're terrible. We don't care about their buy hold opinion because they are always buy and hold for the most part. Analysts are. And so, in general, for all companies. And so when you see that return jump, and then what's been priced in, Rob, by the market? All right, so embedded expectations that this company will continue to have that dramatic rise in profitability, right? As a German company, that it hits like 35%. At this point, you start saying these seem a bit lofty, right? It seems with the $2,000 share price, right, the $97 billion in market cap, what is required to reach current levels, right, is that this company had a 30+% return on assets. And wait, and hold that in perpetuity. It has to hold that 30% forever to generate today's stock price. It seems a bit rich.
And so to put that in perspective, everybody, Lockheed Martin, highest return of the pure defense contractors, the big system integrators, defense contractors, which would be comparable to a Rheinmetall. Lockheed Martin generates, at its best years, 25% return on assets. Most of the time, it's 20%. You look at all the big defense contractors, General Dynamics, probably the closest comp to Rheinmetall, other than the fact that it also makes boats, and also it has Gulfstream. It probably is normally a 10 to 15% return on asset business. You look at Raytheon and Northrop, they're 20% return on asset business. Expecting this company to see a 30% return on asset return on assets going forward in perpetuity just really is way too bullish. We get the idea that Germany and Europe is going to actually have a lot more defense spending. There's a reason why actually there's 1 or 2 European defense contractors that we at Hidden Alpha, our large cap newsletter, actually recommend. But Rheinmetall just would not be one of them. Those expectations are way high. And to put this in perspective, there's reasons why you can expect this kind of sustainable releveling. Because when you see a return on assets ramp like we saw from 23 to 26, there's 2 reasons why that generally happens. Reason 1, you've got a company that has a cyclical super cycle. You've got a whole bunch of demand happening for that company, and it's got short-term pricing power, and that's going to benefit. Reason 2 is there's a structural transformation happening for the company. The company is going from being a manufacturing company to a software company. The company is going from manufacturing commodity things to now it's manufacturing proprietary things. Nothing is changing about Rheinmetall's business. It's still just going to make tanks and ammunition and a little bit UAVs and stuff, but those are a rounding error for the business. And the other thing for Rheinmetall is, and this is the important thing, whenever as a U.S. investor you venture out to the rest of the world, there's a misunderstanding that a lot of people have that the whole entire rest of the world think about companies the way that we do in the US or in the UK, which is what's called shareholder capitalism, which is when you make money, that money goes to the shareholders. Well, in Germany, the reason why Germany has a 4 to 5% return on assets, Joel, as you said, is because Germany practices something a little different. They practice it's a socialist country, they practice what's called stakeholder capitalism, which means, right, they make sure that they share in the big winnings that the company has with their employees and anybody else. In fact, I think it's half of the board of Rheinmetall, like most German countries, is representatives from labor. And so you see that ROA ramp that we're seeing here from 26, you can bet that they're going to get lots of salary wages and bonuses that are going to eat into that return on asset. It's never going to get to 20%, let alone 30. Yeah.
Costs are going to increase at levels that are not being priced in. This stock is just really too expensive for us to get our arms around. I mean, we understand why it's run, and we respect it, and I don't short momentum stocks. But the fact is, to think it's going to have that kind of return in perpetuity. Oh, by the way, there's another thing that's been going on with this stock. Because it is a momentum play, you find that, and the data is a little bit, it's not as great in Germany, I think, as it is elsewhere. But a lot of retail investment, meaning in the U.S., on average, a large 90-something billion dollar company would be 70 to 80% institutionally owned, right, by big funds, right? And you actually find that also in Germany, has big pension plans, whatever else. This company is being held by great majority is retail investors, which suggests it's a momentum play that retail investors own this and not the big European smart money, the institutions. And that also scares the heck out of me about this stock holding these levels when it's retail investors that have pushed it this high, not institutions. That is deeply concerning too.
Right. So, I mean, the moral of the story, everybody, is look, well, we agree that there's going to be some interesting defense plays in Europe. We recommend a couple of them. This is probably not one. This is one you want to steer clear on. But, we started talking about the paper bear that is Russia, and then and why it really is a paper bear from a tax and geopolitical perspective. And we wrapped up with how Rheinmetall is benefiting from that paper bear spookiness. You never know how we're going to get to A and Z from the Altimetry Authority, but that's that. Thanks so much for dialing into this episode. Thanks so much, everybody.
Thank you.
All right, thanks everybody for tuning in. If you want to hear more and follow us on a daily basis, just click the first link below and be able to track what we're doing every single day.